All right. So let's talk a little bit about the psychology of trading. And just want to share experiences, thoughts, knowledge, and then get questions from you all. If you all don't know, I've been trading since 2005. I started off funding my own account with my own money that I had made working in the tech industry for some time. I did my first trades way back when, though, in the late 1990s during the height of the dot-com bubble. I traded Amazon. That doubled the next day, and it just didn't make a lot of sense to me that was happening. There were some other things that I was looking at that didn't make a lot of sense. I was a teenager, so you can't really blame me for being a little bit skeptical about that, not understanding how everything worked. But I took the other side of it rather than thinking this is a magical money machine. They can just print new money, and I just thought, like, wow, if things can double the next day, then no one would ever work. Like, why would you work a job? So I had borrowed funds against what I had earned back then because I started working when I was 12. Been working for a long time. And I borrowed funds from my dad, and I said the next day, just cut it out. And it was actually Amazon and Yahoo shares that doubled the next day. So I cut out of them. And I cut out of them because I just didn't understand what was happening. And if I didn't understand it, I didn't want to be involved with it. And I spent the next several years studying markets and working up the funds to really feel like I had enough to actually trade. And then I opened up my first account back in the day at Scott Trade in 2005, and I started trading equities. And it was really interesting, and it was actually a lot of fun, but it was also quite challenging because I wasn't experienced. I had just had book knowledge, and I was then immersed into the reality of the market, and it took me some time to really get my bearings. But by the end of that year, in early 2006, I also started investing. I started taking my trading profits and not just trading them over and over again and churning, but actually taking those trading profits and putting them into a savings and then investing with that savings, which, by the way, is, I think, a good practice. I've been continuing to do that to this day. I think everyone who's trading over multiple time frames should take a chunk of those profits and put them into longer term investments, just as a way of ensuring, A, you don't kill your trading account, and B, your gains are invested in your future. So let's dive in. First, let's talk about some key points with regards to the psychology of trading. And by the way, if you don't make it to this presentation, or you can't stay the whole time, or you want to watch it again, I am recording it. I will post it on the Trader Aid website later so that you all can benefit from it. I'm going to keep out the Q&A, however, from posting on the website because I want to respect everyone's privacy here. I don't want anyone to be shy about asking your questions. And please note, there are no stupid questions. We're of all different skill levels and backgrounds here. So when we get to that phase of it, I want anyone who's curious, who has anything on their mind they want to share. You can share experiences too, to be willing and free to share during that period. So key points: discipline. Don't take trades that don't fit your system. I know that sounds very self-explanatory. For folks that have been trading for a while, you're like, yeah, of course. But for folks out there that are newer at this game, you might see someone out there trading in something you've never traded before in ways you've never seen traded. And you're like, wow, if I could just do like that, I'd be rich in no time. There's no reason to do that. And we'll dive in more. Every single point here and more, I'm going to elucidate much more as we move forward throughout this presentation. But be careful. Have a discipline about how you trade and don't deviate from it, particularly when you're in the midst of a trade. Objectivity. Focus on the data rather than what we feel. You ever had a trade opportunity come up and you're just 100% certain it's going to be the best thing that's ever happened, and then it turns out to be the exact opposite? That self-certainty, whether we want to call it ego, gut feel, whatever, it can work against us, particularly when the trade doesn't comport to our system and our way of managing risk. So when you're looking at data, when you're trying to qualify what might work and what doesn't work, don't let your emotions confuse you. Drive your process by actually objectively looking at data. And we'll talk more about this. Risk management. Size your positions appropriately to their volatility, but also their overall risk. You could have a low beta stock that still crashes because there's other risks, right? Maybe it trades a certain way for a while and then it just goes off the rails. A recent example of that is Archer Daniels Midland. They had an accounting fiasco. Pushed me way out of that trade. Took a loss on it. Wasn't a very big position, but I took a loss on it. And the reason I took a loss on it is because you had one of those outlier events. Those outlier events in single stocks are something we always have to account for. So even if it's average true range or I-vol, R-vol, or other measures of vol like beta are suggesting that it's, not too aggressive, you still have to qualify that larger risk framework. Like, what happens if there's a materially adverse event at the company? What happens to the stock? And that can happen during earnings or any time in between. And the stock lost over 20% in a day, right? Just look at Tesla, very popular stock, lost 10%, over 10% in a day. Intel as well. These are events that, if you're not sized properly, can be terrifying. But if you are sized properly, it's more like, that sucks, but I'm moving on to the next trade. No harm, no foul. Take care of yourself, please. It's so important that you take care of you, because you're the only one that's looking after your trades. You're responsible for the outcome, which means you need to be healthy. You need to be in a good state of mind, and you need to be able to execute quickly. You need to be able to make good decisions rapidly. And in order to do that, you have to be in good shape. You have to take care of yourself. So let's talk about the discipline component here. There's no reason to take every trade that we might see. I want to emphasize this because I see folks sometimes following along blindly, and they can get very, very hurt. Instead of taking every trade that we see that might catch our interest, take a moment to determine whether it fits your system. Okay? Qualify the instrument. Have I traded it before? Is what I'm seeing something that I've traded before, that I understand the dynamics of this trade so that once I get into it, I'm not just flying blind? Do I have a sense as to what the risk and reward is? Am I getting in at a time that is opportune, or has it already had a run and now those dynamics are skewed? And if we don't have a systematic approach, we should not be trading at all. And I think that's really important to take into consideration, because quite frankly, if there's no system, then you're getting into trades and you're just sort of winging it. And I have never seen anyone be able to consistently wing it trading. It just does not happen. It's very, very dangerous to do that. Okay. Now I'm going to just quickly put out an announcement just to let folks that know that we're doing this in case they can't find it. All right. And once you're in a trade, it's important not to deviate from your system. It's very tempting to, right? Because it's like, oh, look, the dynamics have changed. Maybe there's some kind of event that's happening, right? And you get more excited about the trade, or maybe it becomes a loser, but you're so married to the thesis, you're not accepting to, you're not willing to accept that outcome. Don't get married to a trade, and don't deviate from your system. If you're exceeding your risk because of a drawdown, let it go. Move on to the next one, and don't look back. There's no reason to look back with remorse and say, gee, if I just held on or whatever. That's all a distraction. You have to focus forward. And for the reasons of wash sales, for those of us in the US or other tax regimes that have that kind of restriction, you also don't want to be trying to trade in and out of things that you may have just taken a loss in. So you can realize that loss and offset your gains elsewhere. Because if you forfeit that, that's not good for you, right? You should take those losses and offset your gains rather than just eat them. And I know when we look around FinTwit and other places, we see a lot of folks that seem to be doing well. They project that success, and that's fine. Maybe some of them are, maybe some of them are not. But that should just be motivational to say, oh, wow, some of these folks are really killing it in trading. That means that in time, as I'm patient with myself and I set realistic goals, I too can succeed. And the truth about trading is anyone can succeed at this game, but very few have the patience to do it right, to set realistic goals, to be systematic in their approach, to do the work. And I'm saying this to motivate everyone listening, because I believe all of you can be very successful. I'm sure some that are listening to this right now are very successful. But always be willing to just be humble about where we are in our journey, and not look at others and where they might be, or maybe projecting they are but aren't, and compare ourselves. There's no use in that. That only causes harm. We want to focus on ourselves and where we are and how we can get to where we want to go. And that's a key part of discipline. Be objective, right? This goes back to the idea of not letting emotions filter through too much in our trading decisions. If you're scared, you're in too big of a position. If you're greedy, you're not using your system. You have to be objective. So use data to drive how you model up your trades. You can do back testing. Obviously, we can look at charts and indicators. There's a number of different methods that we can use data and employ it to trade. But if we're not, and we don't have a system, then we're just gambling. And when we become gamblers, we become emotional. And when we become emotional gamblers, we tend to blow up our accounts. And I don't want anyone to blow up their account. And if you're in a position right now where you're like, shoot, I've had so many losers, I think I'm just going to give up on this. It's not working out. Take a break. Figure out what's going wrong. Go through those trades as to why they didn't work. And be willing to accept being wrong. We can't just go with our gut feel on things. We have to have data. This is one of the things that Horst drives home all the time too. And he doesn't just preach it, he practices it. And it's important because if we're not looking through the data of the instruments we're trading, then we don't really understand the instruments we're trading and we could make mistakes. And this is why I think it's really important to create a trading journal so that we can objectively analyze what is and isn't working. We can get to know ourselves more as traders by doing this. And as we get to know ourselves, we're able to start becoming more consistent. We can figure out what assets we're better at trading at, what kind of trading strategies work and what don't. And then we can focus more on that. And again, this is why it's important not to look over at what other people are doing, but focus inward. Because we may not be able to trade the same way they do. We may not have the same internal wiring. And that's important to contextualize. That doesn't mean there's anything wrong with us. We might kill it in a completely different way of trading. And in doing so, we find ourselves, because trading is a journey of self-discovery. You are going to have intense emotions, intense greed, intense fear as you first start out, and you need to kind of recognize what is driving that, how you can get away from that and become more focused, more objective. And I think the trading journal helps a lot because you can reflect. And that is objective. There's no feeling looking back at the last 10 trades and seeing what's working, what's not working. And when I create a trading journal, what I like to do and what I like to advise people to do is to write what you're trading, why you're entering it, how, like, are you doing it all at once, thinking like you're smarter than the market, or are you going in bit by bit, right, to build your core or to build your full position? I prefer the latter. Unless it's a very quick scalp trade, I would rather build that position and then also exit it by taking off my core and then runners later. As you see me set up the trades in the trading ideas room, I like to be disciplined like that because it works out for me more. Anytime I feel like I know exactly where the top or the bottom is, I'm in trouble. But if I'm really being more systematic in my approach and building that trade and going into it over time, I find that I get better overall returns. So that trading journal helps us learn more about ourselves, helps us learn more about what trading is working. And then I like to record how I'm feeling when I'm making that trade. Am I excited? Am I neutral? Am I scared? Am I trading for revenge because I'm angry? Because emotions do matter and we should contextualize how they affect our trading outcomes. I don't think you should trade when you're scared or greedy or angry. There should be really as little feeling involved as possible. Trading should not be an adrenaline rush. And if it becomes one, that means we're gambling. Now, there can always be a bit of a rush when we're winning, and that's fine. But if it gets the best of you and you start taking bigger and bigger risks, then it's counterproductive. So let's talk about risks, because that's what we're doing every day in trading. We're taking risks, right? And you need to be there tomorrow and next week and next month and next year and 10 years from now. Which means you can never have a position on so large that it can blow you up. You have to size your positions according to their volatility and other risk factors. I know some folks only talk about the first part. That's fine. Maybe that works for them. Maybe they're trading asset classes that don't have the inherent risks of trading an industry or a single stock or a region. But I believe that we need to qualify those risks too. Because when you look at especially single stocks, you can be wiped out overnight. And there's a whole period of time where you're not able to trade it, where there could be major news that changes the outcome for the price action. So I think it's really important to make sure that we're sizing our positions not only based on max drawdown from implied volatility or average true range or beta or whatever you think it might be, and where we're placing our stop, which by the way, in a single stock, you place a stop, you can have something run right through your stop before it's even executed. So you have to also qualify that. Like if you have a materially adverse event, your stop is 5% out of where your spot price is, and then you have a gap down, and the thing like in pre-market opens down 20%. Well, you're losing 20% even though you thought your max risk was 5%. So in single stocks, I take very small position sizes in trades. Investments are different. In trades, I take very small position sizes because not only is there the volatility risk in the instrument itself, there's also the event risk. And you've got obviously earnings. We're in the midst of earnings season, so you have to qualify that. What does that mean? It means never trade anything in such size that you're constantly watching your screen. What good does that do? I know we've all done that before. It does us no good at all to watch every tick. You should have a bracket order in. You should know where your risk is and where your reward is before you even enter the trade, so you don't have to put yourself through that. And you should have your position size such that you're not going to lose more than 1 or 2% of your total portfolio value on a single stop out, because then you have plenty of opportunities. Sure, that next trade might not be the lottery ticket that gets you to riches, but no trade is realistically going to do that, especially consistently. Much more often is the case that when we concentrate like that, we blow ourselves up, which is why we should always have stops. Always, always, always have stops. Doesn't necessarily mean it has to be a certain type of stop, right? Some folks prefer trailing stops. Some folks prefer having stops that are at certain key prices. Some folks prefer to move stops based on moving averages. I don't have any strong preference. I kind of build my stops around what I backtest, and the backtesting tells me where my risk should be based on the behavior of that asset. But I would just say at the bare minimum, always have a stop and try not to lose more than 1 or 2% of your entire portfolio on a single stop out. Rule of thumb. This is from traders that have been doing this much longer than I have, and I've been doing it for about 19 years. Don't trade any size that keeps you up at night. If you're having trouble sleeping and you're sitting there looking at your portfolio, or you're looking at the futures, or otherwise you're in too much and you need to downsize. Okay? And this is just like basics, but it's so important because I see people of all skill levels getting caught up doing this when they get too confident, they get too big, and then they get hurt. There's no reason to do that to yourself. And don't trade assets you have no experience with before studying them. It's a great way to get into trouble. If you don't know how something trades and you catch an idea about it and you just put it on, you can get very hurt. You need to spend time learning about the personalities because everything trades differently from one stock to the other, from one futures contract to the other, from one commodity to another, from one country's, index to another. They all trade differently. They all have different personalities, different types of, microstructures, different types of volatility. And we need to understand that because otherwise we're just flying blind, which is one reason backtesting is so valuable. It helps to automate some of the studying of that behavior. So you're not just going back 20 years of charts and looking at, 1-day candles or 30-minute candles or whatever. You're actually having a system do it with a rule framework that you can iterate until you find a process that works. And if you can't, you just move on. Yeah, and that's another thing. Like if you can't figure out how to trade something, just move on. You don't need to bang your head into the wall. There is a universe of different financial products to trade out there, right? So find what works for you. Don't key off of other people. You can be inspired by them. Like I hope you all learn from me. I hope you all learn from Aisha and from Horst and the things we share, but don't just copy us. Figure out what works for you. It is so important. I can't emphasize it enough, which is why I keep saying it. Because our goal here is to get you all to be more self-sufficient, more confident, more consistent. We didn't start this service to be a bunch of shot callers. We want to teach you how to trade and how to survive at this game. There is a high failure rate. A lot of traders don't make it. We want you to beat those odds. So let's talk about execution. When a system says that you built, take a profit, take it. Not before. I see a lot of folks out there just, I've got like a little bit of green. Take it. Oh gosh. Why? Why are we getting out so early? It's working. The trade's working. This is a classic paradox of psychology. Taking profits too early and letting losers run. When the profits are stacking up and everything in our system is saying stay long, there is no reason to do anything. In fact, at that point, it's probably best you just turn off your trading system and walk away. If you're not managing a bunch of stuff, just have your bracket order in, you have your stop, you have your limits, your limit sell, or if it's a short, your limit buy, whatever. Just walk away. There's no reason to micromanage this stuff. You have your system, see if it works. Manage your risk, but don't get micro-focused on every candle. Obviously, if you're a scalper and you're day trading and that's working for you, that's different. I'm talking about swing trading here. And the same is true of stopping out. Don't move your stops around just because the trade thesis isn't working out. Like if something's going lower and you're like, I'll risk another $1 or $2. No, don't do that, because then you're going to get in the habit of second guessing your system. That said, and the thing is, what you do day by day, that sets these habits that then later become behaviors. And when those behaviors become ingrained, if they're good behaviors, you become more consistent. You become more successful. If they're bad behaviors, you become more likely to self-sabotage. So don't move your stops if you're losing. You can move them up if you're winning. There's no problem with that, right? Move your stops into the profit. Awesome. If that's what your system says and that works for you, and if you're going so far as to backtest and that comports with your backtesting, I'm all for it. But if you're moving your stops lower because you're losing, you're going to lose more. And if you're losing more than 1 or 2% of your portfolio on each trade, your trading system's not sustainable. And eventually you might lose it all. So when you start second guessing yourself like this, you need to just take a break. There's no shame in taking a break. Every successful trader that I know, when things aren't working out or when they've had a couple losers or whatever, they just take a break. They go and they read about other things. They go and they do other things with their life. Maybe they go and go on a hiking trip, or maybe they go and read about other traders, or maybe they just, do something completely different, play some video games for a while. Whatever helps you remove stress, clear your head, and get away from this idea of having to revenge trade or having to second guess your system. Because once you get into that mindset, you're going to hurt yourself and you may blow up your account. Okay. And that also means that in your trading account, never have more money than you're willing to lose. Just like every time you put on a position, never put more money into that position than you're willing to lose. Trading is more about capital preservation than making outlandish gains. And I know there's folks out there that are posting huge profits on options trades or this and that and the other, and saying, oh gosh, it's this easy. You just buy this call and you just make money. That's not a system. That's not repeatable. That's not sustainable. Some people are really good trading options and some people kill it for sure. But we need to make sure we're not just gambling on this stuff, right? We need to have a systematic approach, and we need to be realistic with our goals and where we want to be over time. What your goals are for the week, for the month, for the quarter, for the year. They should be something you can achieve. And you shouldn't be benchmarking yourself against others. You should be benchmarking yourself against the performance of whatever it is you're trading, as if you never traded it. So if you're an S&P 500 futures trader, great. That's awesome. Are you beating the index on multiple time frames? If you're not, then you need to go back to the drawing board. Are you a gold trader? Great. Are you beating gold? I mean, it's not terribly hard. Gold's basically not far above where it was in 2011. But are you beating it on multiple time frames? If you are, great. If you're not, time to go back to the drawing board. And that's true of everything we trade on whatever time frame we trade it. You need to beat it, or you're just churning, you're paying commissions. And by the way, when you do your comparison to the index, you need to factor in slippage, commissions, everything. You can't just say, oh, this is my profit margin. Nope. You got to actually factor in all your costs, because you're running a business as a trader, and your business is making sure that you're there the next day to keep trading. And if you don't have any ideas, there's no shame in not trading that day, that week, whatever. You shouldn't have your entire financial future tied up to what happens day by day in your account. So let's think through the process. Do you have a system? Does it work? Are you journaling your trading? What is your consistency rate? How many trades are you winning and how much money are you taking home? What is your max drawdown and what is your max gain? How do you qualify risk and reward? And what is your state of mind when you're trading? These are really important elements to take into consideration. Because if you don't have a system, you're not trading, you're gambling. If your system doesn't work, you shouldn't be trading it. You need to go back and reevaluate what's working and what's not. And if you don't have a journal, you can't do that. So you have to have a journal. And if you do have a journal, you can define what your consistency rate is. If you don't, it's going to be a lot harder. You can always go through your P&L statements and, comb through all your history at your broker, but it's a lot harder to really qualify what's going on there. And what's your max drawdown and max gain? Are you allowing your losers to overwhelm your winners so much that you're not making money? And how do you qualify risk and reward in your trades? This is really important. You have to take time to understand what it is you're trading so you understand the implicit risks and what the upside might be. And if we can't say that we believe the upside is much more than the downside risk we're taking, then there's no reason to put on the trade at all. And finally, what is your state of mind when you're trading? Are you happy? Are you anxious? Are you going through a never-ending adrenaline rush? Are you more zen about it, more focused? Because if you're feeling really strong emotions when you're trading, you're probably going to be more likely to make bad decisions. But if you're letting the system work and emotions are taking the back seat, and look, there's no reason not to celebrate a victory or mourn a loss. You just can't let it affect your judgment. So understanding your state of mind is really important to the psychology of trading and to getting to the next level, to getting to a level where you feel like you're successful. And here are some of the common pitfalls that I see. I've coached a lot of people on their trading. I've talked to traders over the last 19 years of myself trading these markets. A lot of people kill themselves over trading. There is no reason to always have to be in the market. In fact, there's every reason to not always be in the market. I know it feels more exciting to be in, to see, the P&L levels going up and down and watching the chart and seeing how your financial future is tied to whatever it is you're trading, but it's not how we should trade. We should be much, much more focused on mapping out those asymmetrical risk and reward opportunities and only taking those trades as they fit our system in the assets that we're comfortable trading, where we know what our max drawdown is and what the gain is that we want before we even get into the trade. And that, by the way, precludes you from overtrading. Because if you put that much effort into your trading, you can't just trade everything all the time. There's a system. There's a system that stops you from overtrading. And you shouldn't be taking trades that don't fit that system, which will then help you from overtrading. Don't cut winners too quickly either. If something is working, let it keep working. I see folks out there that beat themselves up so much, cutting winners too early and riding losers past the risk thresholds, thinking, it'll come back at some point. I can't be wrong about this. Ego has no place in trading. And positions that are too large or concentrated. This is a huge issue. Now, obviously, if you're only trading S&P futures, and that's all you do all day, then you're going to be concentrated in S&P. So that just means you have to have appropriate size. And we've talked a little bit about that. Right? Obviously, if you're day trading, you're not going to get quite as highly leveraged in a single position, or at least you shouldn't, that you can wipe out your entire portfolio, or at least a huge chunk of it. Even when you're day trading, you shouldn't be losing more than 1 or 2% of total portfolio on any stop out. Now, there's also analytical paralysis, right? There's so much information out there. We can get just stuck and we can't do anything. That's the other side of the extreme, right? There's the one side of overtrading. There's the other side of just not trading at all because we get stuck. The best thing about finding a system is you fine tune what your inputs are and you tune out everything else. That's how you alleviate analytical paralysis. And if you want to add some more data into your system, obviously you have to change the weightings of the other data. That involves a lot of consideration, and you shouldn't be feeding too many data points in. If you're feeding like more than 8 or 10 data points in to make every decision trading, that might be a little much. You might paralyze yourself. You might not see all the opportunities. So there is another side of that extreme. And all in, all out trading rather than using core and runners is self-defeating most of the time. Like obviously, again, with scalping, that doesn't always apply. But when you talk about swing trading, the way I like to do it is I like to average in and I like to then take my core off and then my runners. I am not going to pretend I'm smarter than the market. I want the market to work for me. I'm a small fish in a big sea, right? and I'm swimming behind some whales and some sharks, and I'm just hoping to catch some momentum that's behind them in that wake, which means that I need to be willing to be very flexible. And we do have a lot of advantages as retail, by the way. We can be so much more agile than the big boys. Like if you're running an institutional book of billions of dollars, you can't get in and out of everything in the same day or the same week, but we can if we need to. That gives us a huge advantage that we should lean into. We shouldn't be jealous of these guys. We should be focusing on what we can do. And don't copy others rather than learning what works for you. I know it sounds obvious on the surface, but like if you see folks out there projecting success and saying, oh, it's so easy, you just do this, you just do that. If you don't understand how that works and you can't replicate it, then it's not a system. It's just gambling. So figure out what works for you. Everyone is wired differently, and that's a strength. It's not a weakness, by the way. Just because you might not be able to trade the way that I do or Aisha does or Horst does doesn't mean that you're not going to find a system that works really well for you and helps you find your consistency and your discipline and your success. So learn what trading style does work for you, for your own psychology in terms of your time frame, your risk management, your entry and exit, your asset class, what it is that really allows you to feel comfortable in the market. And, some people have a lot of time. They can day trade. They can, sit there and spend hours in front of their screens. Other people don't. They work full-time jobs. Day trading is probably not for them. Swing trading probably makes a lot more sense. You need to build that into how you're approaching the markets as well. Because if your trading is interfering with your work, that's a whole other set of problems that you don't want to have to deal with. Build your systematic approach by using data to help define probabilities. I can't emphasize this enough. Backtest, 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 and backtest. TrendSpider has good backtesting tools. TradingView has good backtesting tools. There's a whole bunch of different systems out there. There's Python frameworks, or if you're more into coding, you can create your own backtesting tools based on some of the existing libraries and data sets that are out there. But if you backtest, the advantage that you'll gain is having more objectivity and less emotion, more confidence to see your trades through rather than just sort of winging it. Because you'll understand looking backwards what those probabilities may be. And yes, behavior changes, market regimes change. Backtesting is not going to tell the future, but it's going to help you align the probabilities on your side more. It's also going to help you understand when it's time to get out, when there's a change in behavior in whatever it is that you're trading. And remember, just because we have a system doesn't mean we're married to it, okay? You have to be able to iterate it. You have to be able to continue to improve it, which is why you need the data from journaling to be able to determine what is working, what isn't working, where can I do better, so that you can continue. Because trading and really the world of finance, there's no limit to the amount of knowledge that you can accrue. So we always have to keep an open mind and be willing to keep learning. And tune out the noise. Focus on signal. There's a lot of noise out there. It's not going to help you. It's not going to help you become a better trader. In fact, it could do the opposite. It could push you out of good trades. It could get you into bad trades. So for example, most traders are not going to benefit from watching financial TV. So if you have CNBC on, if you're using it for anything else other than like just seeing headlines here and there, just turn it off. Seriously, like if you're watching like, Power Hour or other shows where these guys are pitching these different ideas, it's fine to at least like look at them, but don't just trade them blindly. Please do your own work. I know that there's effort involved in the process, and sometimes that's not attractive. But once you do your own work and you get better at it, you start to ingrain those processes in your brain, and it starts to become more natural. It starts feeling less and less like work and just more like a normal everyday thing that we do. And as we do that, we become more confident in our trading as well, because it takes less effort and we become more consistent and more disciplined getting into those healthy routines and habits. A lot of the information that, is coming out is already known by the market too. So when you read a headline on like CNBC or Bloomberg, it's not like it's like some completely game-changing thing. Obviously, every once in a while, there'll be some big event that is. But even then, we're not going to be able to just make a split second, like massive trading decision on that. So it's better to just not even incorporate that into your process. You should be aware of event volatility risk, but you shouldn't necessarily just trade off of that. A lot of event-driven trading strategies blow up in people's faces. So expand your horizons. And this is something I spend a lot of time doing. I mean, like pretty much obsessively. And I know my partners do too. Spend time learning new skills, theories, and methods, right? There's no one way to trade. You can find new methods to employ that can help you become more consistent, that can help improve your discipline, that can help improve your returns, make them less correlated with the overall market. And that has to do with spending time reading books, watching videos from, qualified experts, or even considering taking classes on finance or economics or otherwise. Like, just broaden your horizons. It helps. It really, really helps because, in the world of finance, we might be able to only amass a handful of sand for the metaphor of knowledge in a limitless beach, but we should always endeavor to have as much as we can and to continue learning, keep our mind open. The moment we think we know everything about trading or we have some perfect system that will never fail is the moment we get in trouble. And don't be afraid to take nuggets of wisdom and apply them to your system from what you've learned. You might learn something from a book you've read and you'll be like, I never thought about that before. Well, your system isn't so rigid that it can't change. You can always consider incorporating new rules, new variables as you evolve. The best traders I know are flexible, not when they're in the trade, but as they're evolving their system over time that defines how they trade. Big difference. And ask traders with more experience questions. Seek mentorship if you need to. There's no reason to feel like you're at this alone. That's one of the reasons we built this Discord and this community is because we don't want any of our members to feel like they're alone. We want people to be able to lean into asking us questions and learning from us and gaining from our perspective so that they can help improve their own processes. And be willing to lean into your strengths. But just as importantly, don't avoid addressing your weaknesses, right? Get to know yourself. Where can you improve? Where are you really good? What can you build your system around? But also, where aren't you so good that could use some improvement? And communities are essential. I touched on this, but while some may succeed on their own, for many, particularly people that are less experienced, it is helpful to have a supportive community. Having others with different backgrounds, levels of experience, and thoughts can help us get rid of these biases that can really undermine our success and provide support during tough times. Every trader is going to have a tough time. Everyone. There's no shame in it. Anyone who's out there saying they win every day and they have like a 90% win rate and blah, 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 they're not giving you the full story. You look at some of the most successful traders in the world, they might have a 60% win rate. But what's more important is how profitable are they? Folks that are misrepresenting themselves, they set a bar of success that might be impossible to achieve. Just like, someone who's looking at a magazine cover and seeing an unrealistic Photoshop version of the human body. That's not a realistic version of what we can achieve. Neither is it realistic for someone saying, I win every trade and I just bought this Porsche off of just buying some options in Tesla and just winning every single trade. That's not realistic. That doesn't happen in real life. Some people might get lucky and win like that. And that's actually the worst thing that can happen to you because it's going to reset your judgment and you're going to start making bad decisions. So having other folks that can help kind of offset that you can lean into, that you can learn from is super important. And always be willing to ask questions, whether it's in this presentation or just in general. Keep an open mind, ask questions. Don't feel like, if I ask this, they're going to think I'm so stupid. No, it's the opposite of that. We want you to ask questions about anything that you think might help your trading or where you don't understand what's going on so that we can help. And we're not going to frown upon that. Neither are other people. In fact, this is probably one of the friendliest Discords I've ever been on. People aren't critical of each other. They want to help each other. And it's great. I'm really happy that we evolved to become that, to realize that vision. And I really want to talk about this part right here because I have heard from folks who've, just kind of ground themselves into dust before by not knowing when to stop. And it's so important to know when to stop. You have to prevent burnout, which means you have to take breaks. If you're feeling exhausted, if you're having a bunch of losing trades in a row, if you're like wondering, is this even for me? Take a break. Don't do anything else. Just take a break. Get away from the screen, get away from the financial news, from social media, just close it all down and do something completely different until you start to feel less stressed. You're not going to make back that loss. You're not going to turn around your game if you're not in the right frame of mind. If you're stressed out and you're depleted and you're feeling, just tired of it all, then just take a break. Every trader that makes it in this game values their downtime as much as they value their consistency. And that consistency has everything to do with coming to the game refreshed, neutral, willing to just look at the market for what it is, following the momentum. And you cannot hope to be consistent if you're burning yourself out. I'm sorry, you just can't. Like if you're not sleeping well, if you're not eating well, if you're stressed out all the time, if you're sweating over every tick in the market, you're not going to do well. On the other side of that, if you're concentrating on just what works for you, if you're trading systematically, if you're taking emotion out of the game and you're becoming more consistent, that burnout won't be a thing. That burnout will become a distant memory. And if you start feeling it again, you know what to do. You take a break. And please take care of yourself. No matter how well or how poorly you're doing in the market, whether you've had the biggest up day or down day in your life, you need to take care of yourself. This is a marathon. We are not running a sprint here. We have to be there years ahead. So you have to think about your future self. What would my future self feel about the decisions I'm making right now? Eat well. A balanced diet helps to improve our health and mental health. Sleep well. 7 to 8 hours a night is necessary for you to function properly. Less than that can impair your memory, judgment, increase the time it takes to make important decisions, and even cause brain damage over time, particularly to memory, cognitive function. Exercise 3 to 5 times a week. Cardio is really important. At a bare minimum, 20 minutes during each session to improve brain power and reduce stress. If you're sleeping well and you're exercising, you'll actually regrow brain cells. There's scientific evidence of that. And if you want to throw in some other fun stuff, you can always do things like 16-8 intermittent fasting, which helps to rebuild your mitochondria, which helps to cleanse your digestive system, which helps to reduce inflammation, which accounts for a lot of the exacerbation of depression and anxiety and otherwise. If you take good care of your body, it will take good care of you. And meditate. Take good care of your mind. 10 to 15 minutes every morning before you trade to center yourself. Meditation doesn't have to be anything fancy. It can be as simple as closing your eyes in a quiet area and just focusing on slowing your breathing and your heart rate. That can be where you start. It doesn't have to be anything too complicated. It doesn't have to be, we're trying to transcend reality or reach nirvana or anything. It can be very simple. Just letting go of whatever thoughts are clogging up your brain and just focusing on slowing your breathing and your heart rate and relaxing every muscle in your body. I hope this was really helpful to everyone. Rewatch it, and if you have questions after you've watched it, feel free to post them in the questions channel or in the replies on the website. And I'll be back this weekend with Navigating the Markets to take a look at what's on my radar for the week ahead. So I'll catch you all soon. Thank you so much for tuning in.